Hello! This video considers step 3 in the checklist dealing with corporate formation and contribution. We've considered the past two checklists. Checklist 1 considered gain or loss, if any, recognized by the transferor shareholder. If we had non-recognition under section 351, then we had to continue to checklist 2, considering the adjusted basis of the transferor in the stock received from the corporation. In checklist 3, we'll consider the holding period of the stock received by the transferor shareholder. The first thing we need to consider is, why does holding period even matter? If you recall from basic income tax principles, holding period deals with whether certain characterization issues, the character, is considered long-term or short-term in nature. Recall that long-term is when property is held for more than a year, and short-term is for a year or less. And recall that we start counting the day after the property is acquired. It's possible, though, that tacking is allowed on some types of transactions. Tacking means that a taxpayer can add on a previous time period in considering whether the item is long-term or short-term in nature. Why does long-term or short-term matter? Because if you're considering items such as capital or section 1231 items in character, it's important because of the possibility of preferential gains or losses. When dealing with the holding period of the stock received by the transferor shareholder, we first need to consider what kind of property is transferred. If the transferor transfers property that's considered a capital asset in the hands of the transferor, or a section 1231 asset in the hands of the transferor, then the holding period of the stock received with respect to that portion of the item received, meaning the stock received by the transferor in the transferee corporation, will tack. The transferor will get to add on the amount of time that was held on to that previous asset. If A transferred a building to a corporation in exchange for stock, and that building is considered a capital asset or section 1231 asset in the hands of A, then however long A held the building will be added on to the stock. Let's say the building is considered capital in the hands of A. If A held on to the building for longer than 1 year, when A receives the stock from the transferee corporation, the stock is automatically considered long-term, because that period, that more than 1 year that A held the building, gets added on to the stock received immediately at the time that A receives the stock. Now, this only takes place if it's part of a section 351 transaction, 351A or 351B. And this only applies to the property that's transferred with respect to capital assets and 1231 assets. And again, we're considering the holding period of the stock received because stock generally is considered capital in the hands of most taxpayers, unless the taxpayers are dealers of securities. If the transferor contributes any property that's not considered a capital asset or 1231, then the holding period of that stock received will not tack. It will be what's called a fresh start. So let's say that A, instead of transferring a building, transfers inventory, which is in the hands of A, not a capital asset or section 1231, to the corporation. And A held on to that inventory for more than 1 year. Well, A does not get to tack on that period, and when A receives stock, A's stock will have a fresh start. Why does this matter? Because if A sells the stock, let's say the next day, it's considered short-term, which results in short-term capital gain, which does not get preferential treatment. Now, what if the transferor contributes multiple pieces of property? Let's say that A, as part of a section 351 A transaction, A is going to transfer a building with a fair market value of $500 and inventory with a fair market value of $200. And A transfers this to a corporation in exchange for stock, which again qualifies as a non-recognition event. Well, the building, let's say, is a capital asset in the hands of A, so we'll say it's capital. The inventory is not capital, nor is it 1231. And let's say that A has held on to both of these items, the building and inventory. A held on to both for more than 1 year. Well, when multiple pieces of property are transferred, the stock received by A will be prorated. Prorated, because the issue is that the building gets tacking. The inventory does not. So tacking, we're looking at whether tacking results. The building, yes. The inventory, no. The way that we do this is the stock that A receives is prorated based on fair market value. We have 5/7 or 500 over 700 because the 500 fair market value of the building plus the 200 fair market value of the inventory is 700. 5/7 of the stock will tack, and 2/7 due to the inventory will be a fresh start. This is what happens when we have multiple pieces of property that are different with respect to some are capital assets or 1231, which again, those tack, and the others don't. If all the pieces of property are 1231 or capital and they've all been held for longer than a year, then the stock automatically is considered long-term tacking. You don't have to look at the days. You don't have to say, okay, well, the building, which is capital, was held for 3 years. Some land, which is 1231, is held for 6 years. You don't care about that. As long as it's more than a year, everything's long-term. The issue is whether tacking happened with respect to the stock. We use the fair market value.